This is the Insider's Guide to Real Estate. I'm Victor Normand, and I'm your host. Today we go inside real estate investment. My guest is Jarod Bloom, who is a principal at Sechrest and Bloom, a certified public accountants in Acton. Please join me in welcoming Jarod to our program. Jarod, thanks for being here.
Oh, thank you for having me.
Let's start off by just telling us a bit about yourself and your company.
Sure. So my name's Jarod Bloom. We have both a CPA practice as well as a financial planning practice, and it's a single firm, Sechrest and Bloom. So on the CPA side, we're doing taxes. I think a lot of people are familiar with that. We're doing tax returns for individuals, businesses, trusts, and estates. And we're also doing some bookkeeping work. Then on the wealth management side, we're helping people with their investment planning, with their retirement planning, with estate planning, with insurance planning, with education planning. So a lot of different areas, and they're all interconnected, but they always seem to have a connection with taxes.
Let's start off by the kind of a basic question, the basic entry point for a lot of people in terms of real estate investment, and that is making a decision to rent or buy. Often you can go online and find these little calculators where you enter 4 or 5 pieces of information and it gives you an answer. Yes, you should rent or buy. Sometimes real estate developers will send a letter to renters and say, if you're paying more than some amount for rent, I have a house for you. But it's more complicated than that. So what's involved from a financial planning perspective on the rent versus buy decision?
Sure. So when you're talking about real estate and investing in real estate, I don't really look at real estate, at least your principal house that you're going to live in, as an investment. It's a place that you need to live. Everybody needs to live somewhere. So it's a place to live, it's a place to build memories. So it's not really an investment from that perspective. But when you are making the decision or considering the decision of whether to rent versus whether to buy, there are a couple of factors that you do want to think about. One of them is how long do you plan on being in a certain area? I think if you're looking at being there for at least 8 to 10 years, that makes sense to strongly consider buying. You also, of course, want to look at the area that you're considering buying, and does it have a diverse economy? Are the schools good? Factors like that. For example, I have a client who has a child. They're going to be going to middle school in 2 years. She wants to stay in the school system, and she's thinking to herself, currently she's renting, and she's saying, should I buy now? Should I wait maybe 2 years when he's about to go to middle school so he doesn't have to change schools, and then I could maybe stay in the same town? Or if it looks like I need to move to a different town for something that's more affordable, that might be the time to do it. So it's factors like that as far as what your life situation is, how long you're planning on being in a certain area, because the real estate market can be volatile, it can go down, and if it does go down, you certainly want to give yourself enough time for the market to come back over a period of time.
Sure. So there's this concept in investing called liquidity, and a physical house is not all that liquid sometimes. So you need to do some kind of forward thinking about with that in mind.
Correct. It's definitely not a liquid investment. Now, yes, you could get a line of credit or you could get a second mortgage where you can take equity out of the home. But that's really not liquid from the same perspective as, let's say, owning stocks or mutual funds or bonds, where you can place a trade and the next day, or it might take 2 days, the funds just show up in your account.
Right.
So that's a real sense of liquidity that with real estate you just don't have.
You don't have that. So let's just do talk about real estate as a long-term investment. You mentioned real estate values go down, and that, of course, is an experience we had not that long ago. But leading up to that crisis, and for as long as I can remember before that, it was almost a given that real estate values always go up. Maybe not by much, but they always go up. Now we know that doesn't happen, and that needs to be factored into a decision.
That's correct. I mean, the laws of supply and demand are economic laws, and that's the same when it comes to real estate, just like it is with stocks, bonds, mutual funds, with any investment. So,
right.
Yes, when we're talking about real estate, there is a history of generally having price appreciation over the long term. Of course, it depends on what time horizon you're talking about, and in short time periods, it could go down just like stocks, bonds, mutual funds can go down.
But in terms of categorically saying buying a house is a great investment, we know that's not always true.
It's not always true, although interestingly, Warren Buffett, a famous investor, one of the wealthiest men on the planet, he said that the best investment he ever made was in the house that he bought with his wife, which he still lives in. And it's a modest home. And, he's saying that because from his perspective, he said, I've had, wonderful years, wonderful memories, I've raised a family. And so he's looking at it from that perspective. If you do look at historical returns for real estate as compared to stocks, let's say, over the long run, stocks will outperform real estate, or I should say have outperformed real estate. Going forward, of course, the future is unknown, but it's likely that stocks, on average, over the long run, are going to outperform real estate.
Well, let me set up a scenario for you, and you tell me what you would expect to find. Let's say two individuals both go into a lender and are pre-qualified to buy a home. They made the decision they want to buy, and for the sake of argument, let's say they're both pre-qualified for a $400,000 mortgage. The first consumer goes out and buys a home, and in fact puts a $400,000 mortgage on the home that will pay off over 30 years. The second consumer still qualified for $400,000, meaning that they have available income to support a $400,000 mortgage, but they buy a much smaller property and only spend $200,000. And then they take the difference, this other disposable income amount they have, and they invest it every month faithfully in stock mutual funds over a 30-year period. So now let's go into the future. 30 years has passed. Consumer one has paid off their mortgage. They come to you and want to take a look at what their net worth is. Let's say it's all tied up in the home. And so does consumer number two. Consumer number two has paid off their mortgage, but they've also been putting these funds aside every month in the stock mutual fund. What would you expect to find?
Well, of course, who knows what the future is. Past performance is no guarantee of future results. However, that being said, I would say consumer two is likely going to be ahead as far as having 30 years worth of investment returns in the equity markets versus that same 30 years in just one real estate market, your house. So real estate markets as a whole might even be up, but of course it depends now on what your specific real estate market is. So I would say that consumer number two in your example is likely going to be ahead and have more as far as their net worth, greater assets, but also they would then have the liquidity of having that stock mutual fund. Now, that being said, this is a very personal decision for someone. And if it's very important for somebody to have maybe a larger house, like consumer number one perhaps bought a larger house with the $400,000, then that's a personal decision. And I think it's very important for any advisor, especially us when working with clients, where we're not projecting our personal values onto the situation, but rather we want to talk through the situation with clients, understand what their values are, understand what's important to them, and then point out the risks. For example, consumer one in your situation doesn't have a lot of liquidity, and if they then want to save for their child to go to college, well, at this point they don't have any assets outside the house, and they may then need to borrow from their equity in the house. So there's a lot of different factors that you need to consider in making a decision, and it's instructive to look back at history, but at the same time it's important to understand what is really important to a client.
Right. So if we looked, if we did some modeling and we went back 30 years and actually looked at the numbers, even with this intervening there's probably been more than one recession within the past 30 years. Again, you would still expect somebody who had diversified, in effect, they have their house and their investment portfolio to have a higher net worth than someone who had just had all their resources tied up in the home.
Absolutely.
From a strictly numbers perspective and not...
Yeah, and that's the key. The key word you used is diversify, and that's an investor's best friend is diversification. Of course, if you pick, let's say you picked Apple stock, well, you weren't diversified, but over the last 15 to 20 years, you would have hit a home run. And there are people who did that, and good for them. But in general, on average, yes, it's important to diversify for improving your personal net worth. And if you have just real estate versus having real estate plus a portfolio of stocks, mutual funds, then yes, I think you're probably or likely to be better off as consumer number 2 in your example.
Mm-hmm. Okay. Now, when you mentioned someone not having disposable income because they've got everything into their home, when you buy a home, again, in both of these examples, there are going to be expenses associated with that. And when the lenders calculate what mortgage you can support, they do include as a percentage of available income funds for a basket, if you will, of other expenses. For a home, you would have to pay taxes, insurance. Bigger home is you're going to have to pay more taxes, more insurance. There's also an item of expense which is really, for many of us, difficult to get our arms around. It's called depreciation. That is it's a non-cash expense, but for a homeowner, it's a very real expense. Explain that, if you would, a little bit.
Well, I'd look at depreciation in a couple of different contexts. So one is if you're a landlord and you're renting out your house, then from a tax perspective, you are taking depreciation on the house, which is then an expense that you have on your tax return. But if you're just talking about someone who is just living in their own house, it's for personal use, the depreciation that you're referring to is just simply that it's a physical structure and that over time it's losing its value. And then there's maintenance that you need to do periodically to continue to keep the house going. So it can be a bit of an unknown, although you can use averages as to, well, what are your specific maintenance expenses going to be for a certain property. So when you're talking about real estate as an investment, whether it's a personal house or as an investment real estate, you definitely need to take that into account. Now, when we talk about other investments like stocks, bonds, mutual funds, those are investments, they don't require any maintenance.
Right.
So there is no concept of depreciation for those kinds of investments.
Okay. But as a simple example, a homeowner, if you had even if you bought a brand new home and you had a 30-year mortgage, you can expect at some point during the life of that mortgage you're going to need to replace the roof on the home.
Sure.
And that's a situation where consumers, not too many of us put aside money in anticipation of that, but rather when it occurs, then we look for available resources, which could include refinancing the house or drawing equity in some fashion out of it.
Correct.
To do that.
I would say as a rule of thumb, and you can go online and look up different rules of thumb, but one rule of thumb is to expect approximately 4% of the purchase price of the house. Expect that amount in annual maintenance. Now, something like a roof, which is something that might have to be fixed once every 10 years or 15 years, or replaced once every 10 years or 15 years, that's going to be more than that regular 4%. When clients are working with us, we have some financial planning software where we set up goals such as these big one-time cash expenditures for things like a new roof or redoing your kitchen or doing a major renovation project. So yes, it's important to keep that in mind when looking at somebody's overall financial plan.
Okay. All right, so now let's talk a little, let's expand the conversation a bit. Let's talk about someone who has a home, their income has grown, they can easily support the mortgage. Now they come to you and they say, okay, Jarod, what I'd really like to do is I'd like to invest in real estate. I've looked at some properties in cities not far from here, and I think I'd like to buy some real estate and rent it out, and I think that's a great investment. What kinds of things would you bring to their attention that they might not be considering when making that kind of a decision?
Yep. So that's something where, again, we don't want to be imposing our values when talking to a client. So we really want to understand what's driving the decision. Are they somebody that really enjoys working on houses, they enjoy, or not enjoy, but they're competent about if something breaks, they're able to fix it because they're very handy. So it's factors like that which we really want to speak to the client to make sure that they understand that these are real issues that can and of course do happen. Now, from an investment perspective, as you pointed out, again, I'm going to say that equities, stocks, over the long run are going to outperform real estate. So when having this conversation with a client, what I want to do is talk to them and say, strictly from an investment standpoint, you're probably going to be better off if you didn't invest in real estate, but you invested in stocks or equities or mutual funds. That's kind of a little bit of a separate discussion there. But again, on average, this is something that historically is shown that equities are going to outperform. So you really want to understand where a client is coming and make sure that they understand the risks. Another significant risk, especially here in Massachusetts, is when you're a landlord. The laws in Massachusetts are very leaning toward being more friendly to the tenant than the landlord. Now, I'm not an attorney, but we recommend that you speak with an attorney that specializes in real estate. And we have some attorneys who we work with that we can refer to our clients for that. But I think that's really crucial because if you're relying on the income from having a tenant in a property, especially if you have a mortgage on that property, you still have to make those mortgage payments. And then if a tenant decides that they're not going to pay you for whatever reason, well, now you have a serious cash flow problem. And this is something that, again, we're talking about diversification is the best friend of an investor. If you're buying stocks or mutual funds, you can buy thousands of stocks in the form of a mutual fund. You have diversification. If you're buying an investment property, you have one property, and so now your investment is very much concentrated into this one property.
So in terms of investment property, someone who's come to you and said, look, Jarod, I've ran the numbers, and look at all the spreadsheets I've done. I've spent weeks and weeks doing this, and I think I'm ready to move. That's all good, and that's all important that they've done it, but then you have to bring them into the real world, which includes things, as you've mentioned, whether they're going to be maintenance requirements. Are you handy? Are you able to do that? If not, have you factored in funds in your spreadsheet to hire somebody to do that? And again, the laws and what do you know about tenant selection? Where on your spreadsheet have you factored in tenant selection? So those are all things that they do need to consider.
Yes, and I think that one of the appeals of real estate is that you're using borrowed money. I mean, the bank is lending you money if there's a mortgage, so you have some leverage. But I think as we all know, leverage can go both ways. So you have the potential for making a lot of money in real estate because maybe you don't have to put as much money down and you're then able to borrow the rest from the bank. That can work if the values continue to go up, but as we saw in the Great Recession from 2007 to 2009, or even maybe a little bit before that too, real estate didn't always go up, and it in fact went down. And if you were over leveraged, didn't have enough equity in your properties, then that really hurt a lot of people.
Trouble. So people like me who read articles about real estate investment. And I ran across a statistic once, and I can't remember the exact percentage, but it's the percentage of people who made their wealth, very wealthy people, from real estate is very high. And so it really has an attraction, I think, for a lot of consumers. But there's a more conservative way to invest in real estate than actually physically owning properties, and that's real estate investment trusts. So tell us a bit about those.
Sure. And I understand some clients, they want to be able to touch their investment. If you buy mutual funds, it's something that's on paper. But if you have a house, I mean, that's a physical asset. I totally understand the appeal of it. Something else that we do talk about with our clients is an investment called a real estate investment trust, or REIT, R-E-I-T. A REIT, simply put, is generally investing in commercial real estate. So shopping malls, things that are in the real estate market where you're investing or you're exposed to the real estate market, but you don't physically own a piece of real estate. Just like a mutual fund, where a mutual fund owns thousands of stocks, and you're effectively owning a small piece of all those stocks. When you have a REIT, that's owning thousands of commercial properties. And so you're effectively owning a small piece of all these commercial properties. So it's a way for an investor to get exposure to the real estate market without directly investing in real estate.
Okay. That's may have some appeal to some people. You may be successful in talking somebody out of actually going buying this 3-family house in Lowell that they've done the numbers on. But so what is if you're trying to advise somebody, and you know, as you said, you've listened to the client, they really want to do this, and there's enough wealth behind them that it's not a completely crazy investment. So what kinds of things besides bad tenants and maintenance might they anticipate happening to that triple decker?
Boy, well, you want to make sure you have the right insurance on the property, that's for sure. So you want to speak to your insurance agent. We work with clients, we'll look at the coverages, although of course the agent is the expert in that field. So we want to make sure you have the right coverage there. From an estate planning perspective, you may want to, depends on how you own the property, the titling of the property, that can be an issue, so you want to then speak with your attorney about that. From a accounting and tax perspective, you want to keep good records. You then want to understand how it's going to impact your taxes. So as you can see, there's a bunch of different areas in someone's planning and a bunch of different professionals that you then need to sort of coordinate here with, and that's something which we do with our clients, with all of their professionals.
So you mentioned at the very beginning that all your financial planning often comes right back to taxes. And so let me describe another scenario. Someone who went out and bought this triple decker and everything worked fine. It had great cash flow, and they paid the mortgage on time. And it was a 20-year mortgage, which is typical for commercial property, lesser a period of time. No longer a mortgage on the property. The property has doubled in value over that 20-year period. What are the tax consequences? So now I've doubled my money, but there are some pretty significant tax consequences associated with that.
Well, there can be. So first of all, it's important to understand what your cost basis is in the property. So generally, cost basis is how much you paid for the property. But then if you've been making significant improvements in the property over the years, I mean, there's the regular kind of annual maintenance. That's not really added to your cost basis. But then if you do significant improvements, to account for, as you pointed out earlier, the depreciation, that also then adds to your cost basis. So the property may have doubled in value, but your cost basis didn't just stay the same. It may have increased by the additions that you've been putting in. From a tax perspective, if you've been renting out this property, you also have been taking, or you should be taking, depreciation on the property over the years. So that then has a tax implication for when you go to sell the property. So there's a couple different moving parts that you really need to speak to your CPA about when you're going to go and sell the property. There can be some unexpected consequences, and it's really important to plan for it. I guess I would just say to really speak to somebody in advance, your CPA.
Are you required to take depreciation on investment property?
You are not required to take it. However, when you then go to sell a property that was held out for rental, you are then, and this is all in general, but you're then supposed to take that depreciation that you could have taken back into income. So it really doesn't make sense usually to not take the depreciation, because you want to be taking those depreciation expenses each year to get the deduction, so that in the year that you sell the property, you're going to then take that back as income, and then it's going to be a wash. But if you didn't take depreciation all those years, you still have to take it back into income. So there's an incentive there to take depreciation each year. And
then there are also issues with respect to a fully depreciated piece of real estate that ends up in somebody's estate. But right now there's a stepped up basis. I know that's kind of a insider's term, but
so again, now this is talking about real estate planning that's connected to your estate planning. So when someone passes away, generally the value of an asset that then the next generation inherits gets a step up in basis. And what that means is they might have paid, let's say, $100,000 for the property, but now 20 years later it's worth $400,000. Well, the person who's receiving it, their new cost basis in the property is no longer that 100,000 from 20 years ago, but it's now the 400,000, which is the value at date of death in general. So there's coordination that should be done with your estate planning when it comes to your investments, when it comes to your real estate. And this is something that might suggest, well, you know what, maybe it's worth holding on to and passing on to future generations. And this is a planning opportunity that you can take this significant gain that you've had on a property or any investment over the years and be able to legally avoid having to pay tax on that gain.
So it may make sense if somebody is looking at selling a piece of investment property later in life and using that money in their retirement. When they sit down with you, you have to explain you have a significant tax obligation here, but if you leave it in your estate, at least the way the laws are written now, your estate gets to avoid that. And you're the day after you die and your heirs inherit it, when they sell it, they'll gain more than you would have gained. Is that generally true?
That's in general, that's the basic concept. But again, I think it's really important to understand what a client's values are, because I have some clients who say, you know, we know our kids are going to be fine because we have a lot of assets, but you know, they've had a really great life, they've had a lot of privileges. I'm not too concerned. If these assets are for us, we're going to spend them, and whatever's left happens to be left for them. So again, it comes down to what the values are.
Okay.
And some clients, it's really important to them to have this legacy that they want to then hand down to future generations. It might be a vacation home where the whole family has gone there, and there's just a lot of great memories. One concern about that, when talking about vacation homes, can be it can be challenging with the family, because you know you might want to pass this to the next generation, and sometimes, and we've seen this with clients, maybe in the next generation, one child is very successful, another child maybe isn't so successful, or one child has more money than the other, and now there's a piece of property that the children are who they own, they want to then use, but maybe one child can financially support the property more than the other, and now there's a sense of fairness involved. So there are planning opportunities
Sure.
that you can do. You can speak with an estate planning attorney for that. You can use trusts. You can then put money into the trust along with the property, so that way it's almost like the trust is self-funded, and it's this gift that you've made to your kids so that they don't kind of have to worry about that. You've taken care of it for them. So again, you really want to speak to
Sure.
an estate planning attorney about that.
And you don't want to be in a situation where your intention is to pass along this vacation home to your children only because of their financial circumstances, they're forced to sell it, because that's the only,
Right.
You can't divide up the house, but you certainly can divide up the cash
Correct.
after a sale. So there are ways to attempt to avoid that.
Absolutely, and
Yeah.
it really comes down to just planning in advance. You can plan for a lot of this, and
Yeah.
you can really mitigate a lot of these potential issues. And we see it all the time where people have not done the planning.
Yep.
And you just wished, oh, if they only did this in advance. It really goes a long way. So I encourage people to really think about these things. Speak with your advisors in advance while everyone's healthy and can make these decisions.
Yeah, good advice. So that just in summing up, it seems like that there definitely are some opportunities to invest in real estate. Much more complicated than you might initially think. As in many things associated with real estate, the more you get into it, the more you realize that you really need to speak to professionals who deal with it, like accountants and like real estate agents. So, well, Jarod, that's the end of our program. You've been very informative. Thanks so much for being here.
Thank you for having me.
That's our show. Thanks for watching. See you next time.